Day weekend. Hope you enjoyed your day off on Friday if you got one. Maybe you're taking a nice long vacation week. The unofficial start to the summer at this point, because summer really already started. Pretty great. 855-411-JILL. That is our
Hi,
phone
I'm Esther
number.
Goulias,
Our
the tax
email
lady
address
from
is
EG Tax, and
askjill@jillonmoney.com.
just like last week, this is another week of our. Hi, I'm Esther Goulias, the tax lady from EG Tax, and just like last week, this is another week of our email. We're chewing up your emails, so we're not going to take live phone calls. But next week we'll be ready for your phone call. So write those things down so that you can call us. We love to help you. Again, if you do have questions during the week, in the middle of the night, you can email us at egtax.com, through our website at egtax.com, and I will get back to you right away because I want to help you. In the meantime, if you're getting letters or anything like that, don't pay we're not telling you not to pay the federal government, but we would like to have the opportunity to look at the letters because I would say, I think like 70% of them are wrong, wouldn't you?
Definitely.
Or a variation of what their
or
answer is.
Partial wrong, yeah.
Right,
So
right.
you just don't want to pay those things. And I don't care if you did your own return and they're sending you a letter. You don't have to say, oh, I didn't use EG Tax. We still will help you. We just need to see what you did, you know.
That's right.
And usually in that situation, we can really, really save you a lot of money. Okay, so we got I'm joined in studio with Christopher Fabian and Tiffany Fabian.
Hey there, Esther.
All right,
Hello.
so we got all of our emails. We ready to rock and roll?
Yes. I got
right.
Eric. Eric says, EG Tax, with the high cost of health insurance that I have to pay now, how much do I have to have before I can use medical insurance on my return? Do braces for adults count? And so the answer is you have to first be an itemizer, and then it has to super exceed more than 10% of your adjusted gross income. So if you made $40,000 a year, it would have to be greater than $4,000. That's what portion will be counted towards your allowable portion of possible itemizing. So it has to be greater than 10% of your adjusted gross income, and braces would count to start slipping you into that 10% figure. Anything you want to add?
You know, it's interesting. I just had my brother's getting married, and
Right.
his future wife has a child that he's a special needs child, and
Okay.
she spent this year $17,000 for him. And she said, because I was telling them, you know, you guys better tax plan because
Right.
with his income and your income,
Right.
oh,
Kabang.
right? And she says, oh, well, I'm just going to be able to write off that $17,000.
Oh, that'll fix
and
everything.
I said, oh, not really, because when you put your entire income together, the two of you, and multiply it by 10%, and you subtract that from what you paid, you almost have nothing left over.
But they might want to consider
And so she
items
says,
married
but-
filing separate.
Okay, but she said to me, well, actually, she's the heavier of the two people. My brother's the poor person. But anyway, but she said to me, well, but if I get to that 10% over, then it's all deductible, right? And I said, oh, no, it's a subtraction from the total.
Very
She said, well,
common what she
that
thought.
doesn't seem very good.
No.
I said, so if your total medical's $18,000 and you guys have to take off $14,000,
Right.
you get $4,000 deduction. $14,000 comes off of the 18. And she says, I don't get the whole thing. No, you don't.
Yeah, very common.
So then my brother
misunderstanding.
said, should I not marry her? No, you should definitely marry her.
That's funny. That's fun. But anyways, it's not a very good proposition, right? I mean,
But I mean, they
And it's not easy to take medical.
right. But if you're getting close, like maybe you're doing the braces and you're paying the health insurance through the exchange now, you know, save your copays, save your prescriptions,
Mileage,
your mileage,
glasses, dentist,
anything and
braces.
everything. Yep,
Plus is-
counts.
And
you can't take over-the-counter medication, but you can take, those braces and, all the heating pads and,
And
know.
if you're over the age of 65, you have a few more years that it's 7.5. Isn't that correct?
I think this is the year it's gone.
2015 is the last year.
Last year, right.
Right. So the year we're sitting in right now.
This year's still good, but next
Right.
year.
So if you're over the age of 65, you have a smaller hump
Right,
to get over,
7.5, yeah.
but not for much longer.
Right.
But that's the long
But
term.
that'll also include your part of your
Social
Medicare,
Medicare.
your long-term care insurance,
Yep.
Yeah.
So that all, but that's a good question. Okay, what else we got?
Let's see. Lou writes in, I have a rental property that I would like to sell. I'm turning 70 and moving to Charlotte. It would be too hard for me to manage from down south. I've had it since 1980 and right now could sell it for $150,000. What does this mean for me come tax time?
Well,
I'm thinking he should call Rostello.
1980 to 2015 means it's fully depreciated.
Yeah, that's prior depreciation method altogether. So it's been
So what we're saying is, if you paid, what did it say you paid for? It doesn't say.
it doesn't
Right.
even
But whatever you paid for it, you've been writing
Sell
it
it.
off systematically over those years, which means that it's like, as far as the IRS is concerned, you paid zero for it. So if you sell it for $150, the gain is $150, and that'll be reduced by any expensive sale or any other depreciation that you might have on some assets that you might have done recently, like a new roof. But pretty much looking at $150,000.
That's a substantial capital gain.
I would think that he's probably going to pay $40,000 in taxes between
Right.
the state of New York and the federal.
Yeah, I mean, but one thing Tiff mentioned it was, okay, you said it's too hard to control from down south. What about exchanging it
Good
for another
point.
rental
Good
property?
point.
Said he
Good
should
point.
call
That's what
Mr.
I
Russ.
said.
Yeah.
Yep.
Right. So an exchange, let's explain what that is. It's
1031.
really a tax deferred exchange. So let's say you're looking at paying $40,000 in taxes if you sell it outright. But if you take your property in Buffalo and exchange it for a property in South Carolina, then the basis from your Buffalo property goes to your South Carolina property, which would be zero. But you're not going to pay any taxes until finally you get rid of the South Carolina property.
Right, and hopefully you'll
You'll
die,
die.
and then the
Defer.
beneficiaries inherit the stepped-up value. So
I'll be the only person when I die. Everybody goes, "Yes, her plan worked.
Defer.
Her plan worked." Because I try to defer as much as I can, and then when I die, it'll just be a wonderful thing because my heirs get the stepped-up basis, and that's what I am trying to do. So defer, die, but in the meantime, if he wants rental property in South Carolina,
Yep.
he's got it.
Yep.
Right,
I mean,
right.
so definitely give us a call more. We can talk about it. We can give you Russ Gullo's phone number where you can talk to him. We've had these special guests on all summer for a reason because these are tools that people can use for their advantage.
That's exactly right.
And if you need them, give us a call.
That's called the 1031 exchange.
That's
okay?
right.
And it's federal and state, so it's a great way to. And then one other thing is you might want to just in your little tool chest as well. Let's say that your house is paid for. It sounds like it could be. Let's say you don't want a house in South Carolina. Another option would be to hold the mortgage,
Yep.
right?
Yep.
And so you can do an installment sale, which would make you pay back
A little at
a
a
little
time.
at a time. Okay, so that's another thing you could do.
Okay, I got Susie. Between me and my husband, our income, Esther, it says is $175,000. We have 2 children. One is a junior in college, and the other one is a freshman. Is there anything I can do with their education? Should we let them claim themselves? Would it help if we max out our pension contributions?
Would it help?
Yeah.
Hello.
Yeah.
All right,
yeah.
why?
Because the American Opportunity Tax Credit is phased out based on your earnings and
Earned income.
and their earned
Your
income.
AGI,
And
yeah.
so I think it starts phasing out when they're at 150,
60
160.
to 100 and totally phased out at 180.
So yes.
So if they
yes.
both put away
15.
15,000, they would knock it down 30,000, so they'd get the full credit,
Right. Right.
And if you don't, you're just shooting yourself in the foot because you're going to lose the credit. The hard thing is that I found is that people that as they earn money, they start to expand their liabilities. You know, they get the more expensive house, they get the more
Boat.
expensive car, right? And then all of a sudden, they need all that money to live on,
Right.
And so the Internal Revenue Service then just says, "Well, great, you don't get the pension, you don't get
Right.
the credits."
Right.
Yep. I mean,
Okay.
break.
Yes, I know. I'm sorry, Chris. Hold that thought. I'm Esther Golias, the tax lady. We're from EG Tax. We're taking a short break. We'll be back right after this short break. Thanks. Hi, I'm Esther Golias, the tax lady from EG Tax. This week, we're not taking our live phone calls. Next week, we will. We're just kind of chewing up emails, and I just stepped on Chris before the break. I didn't step on you that
what
bad.
were you saying
and
about
and
the
you were going to
college?
say something about
Yep.
college.
Well, you know, why? Okay, so they take the 30,000, put it in their pension plan, each of them,
Right.
you know,
Collectively.
collectively. That's a $5,000 tax savings on their
Right.
tax return.
So not only are going to save $5 in taxes, and they're going to get the full education credit, and it's
Right.
remarkable.
Right. Well, yeah, not to mention not paying taxes on that 30,000, so that you do save the 5,000 there, but then the 5,000, so that's a 10,000. So really, you're only missing $20,000.
True. That's
I mean,
true.
yeah, it's still a lot of money, but maybe you can do it.
I've gone so far with some of my clients to say, look, let's load up your pension plan, and you have a paid-for house, and so you're going to be short. Let's say, 20,000 a year. All right, let's say 40,000 between the. Have you thought about doing a home equity credit
That is
line
so smart.
for that period of time? Because you're going to get the full credits,
Right.
and you're going to save the income tax.
Right.
And so, yes, you're in debt. Let's say at the end of those 2 years, $30,000 or $40,000. But the thing is, then you start paying that off, and what you've saved pays for the interest plus.
And you get to
And
write
you,
off
and
the,
you still have all this money in your pension
right,
plan.
and you get to write off the interest on the home equity. That's
And you
called
still have this money.
clever. That's called
There's a way. If there's a way to skin a cat.
Yikes. And don't forget, I want to mention to Susie, there's also a college credit on New York State for people below bachelor's and below. So don't forget to take advantage of that.
But she would have gotten that no matter what. New York State
Yeah.
lets you be rich, and they still give you the credits.
Right. That's
They
exactly
do, because
right.
there's a lot of rich people in New York State.
Right. And then
Not too many in Western New York, but a lot. I know, like when we all went to Manhattan not long ago, there are. I mean,
We saw some
limousines.
nice
Yes, hot and cold.
I saw
running
a
limousine.
camo limo. It was a like pink and orange camo.
Oh, a camouflage. I thought
Camouflage.
you meant it looked
Camel.
like a camel.
It had two humps.
Camouflage.
All right. What
I've
else
got
we got?
Laura, Esther. My husband finally got approved for Social Security disability after fighting them for 3 years. I heard that is tax-free. What about the money we receive for our children? And so you don't have to declare that Social Security that you get for the kids on the tax return. But there is a chance, Laura, you want to be careful that some of his Social Security that he gets every year could be taxed based on what income you have as well.
And all of that. Let's say that you applied 3 years ago, and so let's say they gave you 75,000. Maybe 20 of it is for this year, but the other 55 was for the previous years while you've been fighting it out with them.
Right.
Well, that
That-
probably definitely be taxable, but you can do something that might save you some money called a lump sum election.
Right, where we look back at the 3 years or whatever years involved for the settlement, well, not settlement, but the lump sum payment, and we get to look at your tax situation for each year and say, well, what if it was received in that year?
What would it have been taxed?
Well,
at?
how much would have been taxed? And then, obviously, if you've been fighting it for 3 years, you also probably have lawyers' fees taken out of it.
Right.
If there's any part of the taxable Social Security that is taxable, we can take that portion of the lawyer's fees and as an itemized deduction subject to 2%, but it could help.
Right.
You know, also if maybe he was on workman's comp, now Social Security's
Might have made
taxable,
it
and
pay
now
back.
they're paying back workman's comp. That's a deduction on your Schedule A also.
Right.
But I'm really glad she asked, because the truth is she's getting bad information when they said, I heard that's tax free.
Right.
And so really
They're
smart
going to
of
send
you.
you that pink and white form at the end of the year, the SSA form, and if you don't put it on your return, it'll be very sad.
But you're also going to get a pink and white form for the kids, and that doesn't go on
go on
your tax return. Yeah.
All right, good. What else we got?
Marcus writes in, I'm working in Buffalo for a short period of time to get a new manager trained so I can go back to Florida. I've been here since March. What a shock. I've never seen snow before. And should be moving back soon. The company pays for all my housing and food. Is there anything else I can write off? By the way, we don't have anyone in Florida like E.G. Tax. I enjoy your radio show.
Isn't that nice? That's a nice thing. But we're in Florida.
We are.
in
We're
Naples.
right near Fort
Where's he at?
Myers.
He's in Fort Myers. Oh, my gosh. So, yeah, Marcus, use us at Fort Myers, at our Naples office. Okay.
So
Well,
the
he's on what's called a temporary
temporary
assignment,
assignment.
which is really a wonderful thing because what?
He gets to deduct the going back and forth from home to Buffalo. He gets to his cell phone, his living expenses, but it sounds like they reimburse him for it. His food, all of his food, and so it's a wonderful thing. You
Basically,
get to take all your
the
expenses.
that he
Incurs.
living outside of his tax home, which is Fort Myers, right?
Right.
Is all going to be deductible. Now, if they pay for his housing and food, do they pay for the utilities?
Correct.
You know,
Correct.
because the utilities would be deductible. Are they paying for his cell phone?
Right.
You know,
The internet.
the internet, all of his supplies, things of that nature.
he goes back
his
home.
travel, right?
Yeah.
All those things. So he would list that all on a 2106. Now, what if Marcus loses his mind and he says, "Oh, I don't want to go to Florida. I just would rather stay here
I
forever."
love the snow.
Right. I just love the snowfall. And he changes it to a permanent location. Then, of course,
None
that would
is
not be
deductible.
deductible. And it's considered it's you lose that deduction once it's more than a year, right?
Correct.
Right, yep.
Correct.
So, okay. So that's Marcus, yeah. And Marcus, we're on Airport Pulling Road in Naples.
Across from Tamiami Ford.
Ford, right.
Right.
All right, what else we got here?
I've got Morgan. He says, Esther, my son worked last summer, so when I did my return, I included his W-2 in my income since he's my dependent. He just got a bill from the IRS asking for a copy of his tax return. What do I do? And I heard Esther chuckle over there because unfortunately this is very common. We'll have parents and they bring their kiddos W-2s, and they want to put their kiddos W-2 on their return, but that's not the case. That W-2 for her son should have gone on her son's return. He could still be claimed as her dependent, but he's going to file his own return, and so she will have to amend her return and take off her son's wages and put it on a return for her son.
And probably this is what's going to happen. Let's say the son made $3,000. Okay,
Right.
he's not going to pay any federal taxes. He's not going to pay any state taxes. When the $3,000 comes off the parent's return, if they were in the 20% bracket, they're going to save like $600 in federal taxes. And
Hello.
let's say and $500 on the state. So it's like an 85. It's like a I lost my math. Anyway, but it's about $700 in refunds they're going to get because you don't include your kids' W-2s on your return. They do a return and you do a return, and that's it.
And not to mention, if you included his wages and it precluded you from getting the student loan interest write-off, or it precluded you from getting the retirement savers credit. I mean, the credits are all based on wages and income earned, so there's things that could slip you out of those credits. So you just want to make sure you do the amended return.
Right.
Yeah.
Okay.
Yep.
All right. What else we got?
We got Jennifer. I am thinking of opening up a small beauty salon. What do I need to do so I don't get in trouble with anybody? What else do I need to worry about besides the IRS?
New York State.
In more ways than one.
In 3 words, New York State, because you want to make sure that you have all your T's crossed and your I's dotted, which would mean that you need to get a sales tax number with New York State, because all the product that you're selling in your beauty salon, you have to pay New York State sales tax on.
Correct. And you really want to make sure you do that right from the get-go, because you don't want to get behind, and you don't, like Chris said and Esther said, you don't want to have New York State come in and do an audit or send you that letter in the mail And I think Chris could speak for me. He's seen it too many times, people not doing the appropriate thing with sales tax, right?
Oh, sales tax is a nightmare in itself. But are you going to be a single person? Are you the only person working there?
Employees?
Are you going to have employees? I mean, there's different. You got to look at, if you have an employees, then you should get a payroll service to make sure all your payroll taxes get paid, your workman's comp insurance.
I guess the first thing I'd say, Jennifer, is you want to make sure you have proper insurance. You make sure you have proper insurance, even if it's by yourself. You want to have liability insurance. You want to make sure if somebody trips coming in the front door, you're not going to lose everything. Secondly, is you should look at becoming an LLC.
Right.
A limited liability company, because if they do trip on the front door, and even if you have insurance and the insurance company says, oh, you didn't snowplow, it's your fault, and they don't pay, you want to make sure that all they can do is take the assets for the business and not start suing you personally. Then the next thing is, like Chris says, do you have employees? Did you do your workers' comp? Are you paying them payroll? Are you tempted to put them on a 1099 form? All those kind of things you want to make sure that you have in place. And then finally, you want to make sure your bookkeeping is done right.
Right.
Right?
Yes.
I mean,
yes. Talk about dotting your
who
I's.
needs this receipt? Well, just throw it in the garbage can. You want all your receipts. You want to make sure everything paid. You have on ours, when I pay the bills, when I write out the check, I staple the bill that I'm paying to the bottom portion of the check. It's in the checkbook. It's logged into QuickBooks. All those things are so important. And when are they important?
When
The IRS.
Hello.
Hi, I got
Right.
nothing else to do. We'll just come out and say hi to you, right?
and claim all the income.
I'm Esther Gullius, the tax lady from EG Tax. We're going to break for the news. We'll see you on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax. We're not taking live phone-ins this week. We will next week. If you have something that stirs your questioning in your brain, you can get to us at egtax.com. Ask the tax lady. Email us, and I will get back right away to you. But right now, this week, we're just
Answering
emails. Okay, what else we got, Chris?
Well, this sort of relates to the last one. This is from Jacob. What is the difference between an LLC and a corporation?
Oh,
My
good
lawyer
question.
says I should do an LLC because of the protection. But doesn't a corporation have the same protection? What is the tax difference?
Well, the thing is, an LLC is just like a sole proprietorship, except the assets are you can't be sued for more than the assets of the business. Okay, and that's the same thing on a corporation. What you find out though is that a corporation, depending upon the size of the corporation and how many other employees that you have, if the corporation, let's say, grows into something pretty substantial, and you can always make the election to go from an LLC to a corporation. But as you grow, as the company grows, a corporation gives you a lot more latitude, ease of sale. And let's say that the net profit in a couple of years is $200,000, and you're getting your salary, and let's say of the $200,000 net profit, a lot of it was made by your employees. Then you can take, rather than taking it all out in salary where you'd pay all the FICA, as long as you're getting a reasonable salary, the net profit can come out to you as an owner's draw, and you don't have to pay the FICA on that. So those kind of things. Now, obviously, on an LLC, you can do a solo 401k, so you can actually put more away in a solo 401k than if you did a simple plan for a corporation. So it really has to do with, it's like taking baby steps to protect your asset.
Right,
Right?
right. Yep. I mean, tax consequences, there's a lot of different, besides pensions, there's different ways corporations are taxed, whether it's a C Corp or an S Corp or an LLC, because an LLC is still treated as self-employment. So you could end up paying a lot of extra money by being an LLC.
It was very interesting. One of my friends owns a business in Michigan. And for years, he has a very large resort, quite frankly. And he's had an LLC all these years, and he has all kinds of employees. And so he's been paying FICA on basically the efforts of all of his employees because his accountant never elected to make him an 1120S. So we were talking, and I said, I do not understand why you're not an 1120S, because you're paying all this FICA that you don't need to do. They don't have a pension plan, and it really comes down to, like we've been saying, planning. You should. It doesn't hurt to get a second opinion.
Right. Always. And look at the costs too involved in becoming an LLC compared to becoming an S Corp or a C Corp, because that's what you become first. Because there is a substantial difference in the price. It's about $1,000 savings from one to the other, and lawyers.
But what you do obviously on an LLC, it's just a Schedule C on your tax
Correct.
return. But on an 1120S, you
It's
actually
a separate tax
separate
return.
filing. Yeah. So it's interesting because a lot of times when I'm telling people that they should incorporate, it takes them about 5 or 6 months to get used to the mumbo jumbo of the separate bank account, and because it really is a separate entity. But in the long run, it really is a great tax saving.
I love when I tell people, and they go, but don't I have to hold meetings and all this stuff when I'm a corporation? I say, yeah, but it's like playing chess against yourself. And they look at me and they go, what do you mean? I say, well, you're on one side of the table and you say, we need to start looking into a pension plan this year. And you run around to the other side of the table and you go, that's a good idea, and you run back to the, and you just have a meeting with it
Right.
doesn't have to
and
be.
you do your minutes,
you
where
keep
your
track.
annual meeting, where you say, this is our goals for the year. And
Yep, and people will laugh. They go, that's it? I mean, I don't have to go anywhere to have this meeting and do. No.
Yep.
It could be at your kitchen table, and
Yep.
and it doesn't matter.
or
but
wherever you
gotta-
have a meeting with yourself. Yeah.
Yes.
Yeah. So anyway, okay, what do we got?
Diane writes in, my son has defaulted on all his college loan, and now it's up to us to make the payments. Oh boy, sounds like a Parent Plus loan. Right now, the interest is sky high and is killing us. Any suggestions? He owes almost $25,000, and our income is fixed since we are retired. We don't have any money in investments or savings, just our home.
Wow, that is tough, isn't it? I mean,
Well,
there's a lot of parents
first
in
of
that
all,
situation.
If they didn't co-sign,
Well, it sounded like they did, though, didn't it?
right. But I'm just saying,
Right.
that's
If they didn't co-sign,
then they don't have to pay.
that's true.
You know,
if they didn't, and that's something parents need to think about before, when kids are going to college, it all sounds so wonderful, and we're going to go off to Syracuse, and we're going to borrow $40,000 a year, but it's, and there your kid goes to college, maybe for 2 years, you got $80,000 in debt, didn't get the degree. That's why before you make the debt, you really have to think about somebody's got to pay the debt. And I don't mean to be preaching to this lady, but I am a big proponent on whatever is the cheapest way for your kid to get into college to make sure that they're going to make it before you go and do all of this darn debt that you have to pay back. That's what you should do. In this situation, the $25,000, I guess their home is paid for, and if they did pay, I think they should look at a home equity.
Yeah. Look at it, definitely. I mean,
They can do $299
yep.
on the $25,000. Pay it off over a short period of time. It's going to be tax deductible. Low, the interest rates are low, and I guess I'd have a big conversation with my son, or I'm assuming it is her son, and say, all right, here's the payment. The payment is $400 a month. It's not $2,000. It's only $400. You have to pay mom and dad's home equity.
Why did he stop paying it first? You know, I just don't want to care about my student loans because it didn't help me. I went to Syracuse, like you said, and I didn't get my degree, so why should I bother paying Syracuse back?
Right.
You know, well, if that's the case, then I would almost say something not nice to my kid. But
I can't picture not saying something nice to my kid. I mean, I know that I'm a toughie, and I just think that when you make before you go ahead and create a debt, you have to be understanding that you're going to pay the debt back.
Yep.
I mean, I believe morally that's what you have to do.
Yep.
So, but a lot of people are out looking for loopholes, but unfortunately, mom and dad, I think the best thing you could do is the home equity credit line, because you are not you're probably paying 7 or 8%. So you're going to save 4%, it'll be tax deductible. It's true that student loans are deductible, but only up to $2,500 in interest. So you're going to control the payment, and I would suggest that you have your son make the payment. The other thing that people can do, because it's so difficult getting out from under student loans, is become an employee of a not-for-profit for 10 years.
Yep.
Right?
Yep. I mean, look into it, because not-for-profit, the school systems in minority areas, they offer this program. I know I have someone who does stuff at UB, and he's in debt 6 figures. But after 10 years,
it's gone.
It's gone. I mean, and that's the University of Buffalo. So, I mean, we're not talking working in the middle of the city of Buffalo. Right. Not that there's anything wrong with it. But, I mean, so there's different programs out there. You got to do the research and look into it. I know I was talking to my sister the other day about this and with her children, and they're like, she's like, but we can't because they had to look at my income. They looked at the parents' income, and I said, that has nothing to do with it. Oh, yes. You got to do a lot of research to see, because they're, Now,
when you say, I can't, what do you mean I can't?
She said that the children couldn't go into these programs because when they signed up for the student loans, they looked at the parents' income. And I said, I don't think that really has anything to do with it. If it's the kids' student loans, because it was for graduate school, the parents weren't involved, then they should be able to go into these programs. I know they're in a different state.
But this is a federal program.
Yeah.
So, and obviously New York State has a lot of their own programs as well. But that's what I would do. And parents, sometimes you have to just say to your kids, no, you cannot go to Syracuse. Not that there's anything wrong with Syracuse, because Syracuse is a wonderful school. If you got all the money in the world, great. But if your kid is just kind of not sure what he's going to do, and you're going to have to pay back the loans, think about when you pay back. There's a lot of kids that I've been reading all these articles on. There's a number of children who just people think that kids got to go to college. Maybe they should go to a trade school. Yep. Not everyone's made for college.
Yep, definitely.
Okay, what else we got?
Dominic writes in, I'm turning 70 and a half in September. I'm still working full time. If I'm contributing to my 401k, do I still have to take the RMD from my IRAs and my 401k? What is the calculation to figure this out?
Okay, well, that's you answer it.
Well, 2 things. First of all, since you're still working, the 401k you don't have to take your minimum distribution out of because you're still contributing to it. So you're fine there. Keep contributing. You don't have to worry about it till you stop working. Your IRA, unfortunately, you still do have to take out your required minimum distribution. And there is a life expectancy table. In the first year, you divide it. It's not a percentage. You divide it by whatever your account balance was at the beginning of the year by 27.4.
And that's your minimum distribution.
Yep.
And you can put all of your IRAs together, figure out what the balance was as of 12/31, and use that divisor, and you can take it out of any one of those other IRAs, like the one obviously paying the least amount of interest would probably be.
I mean, even to say, but if Dominic doesn't want to pay taxes on the $5,000, we'll say it's $5,000 he has to take out. load up your 401k.
Right, offset.
Offset
In other
it.
words, if you would normally put 10,000 in your into your 401k and you have to take 5 as an RMD, now put in 15.
Right. So now
And
you're the same and
it's
your
a free
taxes
thing.
are the same.
Correct. I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break for news. This week we are not taking your live phone-ins. We will next week. If you find something that you think that you'd like your question answered, you can go to our website at egtax.com. And click on Ask the Tax Lady, and we'll be very happy to help you. So we're going to take a short break. See you on the other side. I'm Esther Golias, the tax lady from EG Tax. This is the last segment we have this week of our email answering. We're not taking your live phone calls. During the week, if you have any questions, our office is open on Niagara Falls Boulevard, our corporate headquarters, from 9 to 5. Stop in. If you're getting love letters from the IRS, don't pay them. I don't care if you did your own return. Don't pay it until you let us look at it, because many, if not most, of the letters are, if not completely wrong, are partially wrong. And you really want to have that second opinion to make sure that you don't overpay your taxes. Okay, Chris, what do we got? Chris Fabian, our VP, what do we got here?
Tom writes in, I'm perplexed about gifting my house to my kids. Should I or not? I am 70 years old and have lived here for over 40 years. When my wife and I bought it, we paid $55,000. Now it's worth about $155,000. So what happens if I do or don't give it away?
Okay, so the important thing is if he there's two things. If he's looking at nursing home expense, he wants to make sure that clock starts ticking 5 years. And if he's going to do a life estate, then if he does it right now and he retains ownership because of a life estate, then it's going to be, the kids will get a stepped up basis. If he gives it to the kids, actually changes the title, then what happens? The kids will end up having to pay taxes upon his death.
Yep.
So really, I think you need to have you really have to look at all your assets, what your goals are. Do you have long-term care insurance? All those kind of things go into the mix. And, of course, if he were to sell it now,
there's no tax.
There would be no tax at all because he lived in the house 2 of the last 5 years. Yep. So do you want to sell it? Do you want a life estate? If you gift it to your kids, the kids own it, then and it starts, again, the 5 years starts, look back starts from the time you either do the life estate or gift it. And if you do go into a nursing home, the asset could be partially taken back during that 5 year period. So you really have to do some tax planning.
Yes.
Right?
Definitely.
Okay, what else we got?
I think that's the theme of these shows. Tax plan, tax plan, tax
Amen.
plan.
That's for sure.
Sarah writes in, I'm getting married in a month. Speaking of tax planning, my mom says we should come see you for tax planning. Do you do this? And what should we bring? And why should we?
Oh, that's so great. Okay, well, yes, especially when you get married. And now it's not like it used to be 70 or 80 years ago where nobody brings any children into the marriage, because, now it's, with divorce is much more prevalent, and many times there's children from other relationships. So you want to talk about who's got custody, who's the parental parent.
The custodial.
Thank you. I knew there was a word for it. All that kind of stuff. Does the new husband have children? Does he have child support? Is he paying maintenance? All that kind of stuff. Combining salaries. Maybe he didn't have much income. You're the big wage earner, or vice versa. Maybe you should file separately. Yeah, we think you should definitely do that.
Yep.
And with the extra household income, and then maybe won't be an extra household income. They've been living together for a long time.
Yeah,
right?
yeah.
But
the credits, everything in there.
And the other thing is, they might have had an earned income credit in the past, and now you're going to lose that.
Yep. So
and people will say, "Gee, should
I not have got married?"
Yeah, that's true, because being single, you really many times is a much better tax situation than filing jointly.
Yep. Sorry to say that,
right? But I would see, and there's no charge. And what do we need? A copy of last year's returns, maybe your W-2s right now, or your pay stubs.
Yep.
Yeah,
Yep.
Your house payments. marital situation, all your
So
your
listen to
children.
your mother and your Auntie Esther.
That's right. All right, what else we got?
Mark writes in, I had a solar company come to my house, and they told me that there are credits for both the federal and the state totaling about 55%. Is this true? If so, then I would only pay about 1/4 of the actual cost after their rebates. Do you think I should proceed?
Well, it's not cheap to do.
No.
But yes, I mean, if and then again, I've heard it both ways, where the credits are really great.
Well, they are credits, but they're non-refundable credits.
Right.
They're Pac-Man credits, as my wife would say.
Right.
So all they're going to do is eat your tax liability and then go forward
Right.
to next year.
But
so
assuming
luckily,
this guy's got a
the
liability.
Right.
So yes, but the cost of the equipment is not cheap. And so what you have to do is say, how much am I going to say? What's my bottom line going to be? Right?
Yep.
So if it's really going to cost you after credits $15,000, then you have to say, all right, how many years before I recoup that $15,000 from the amount I'm saving?
Yeah.
And then if that's the case, do you have to put new equipment in, and will that be, and will there be credits again? So I've heard it. It's great, but don't let the tax savings.
Say, do it.
Right,
Yeah.
because you never do something just for tax savings.
And make sure your house is pointing the right way. Because I had someone come in and their house was facing east and west. And the company said, no, we're not going to do it.
But they
you
didn't
have
do
to
it.
face north
Well,
and
thank
south. But
God.
they wanted to, but they couldn't just because of how their house was
Right.
positioned. So there's a lot of things to.
Well, it is not cheap. I know I had one client that did it. I think it was like $45,000. So there were big credits, but it's a large expense.
Yeah,
so
yeah.
you got to make sure that you put a pencil to.
And we're in Buffalo.
And so what would that mean?
Is-
sun.
what
No
shade of
sun.
gray is it
Ain't
today?
that true? That's for sure. Okay, what else we got?
Okay. Ralph writes in, I had a good year at the casino, winnings of about $50,000. What proof do I need for my losses? I don't like the win-loss statements because they always say I have way more winnings than the jackpots that I win. Can I use instant lottery tickets as well to offset the winnings?
Well, yes, you can, but
No, you can't.
no, if you logged them in.
If you logged them
If
in
you
and
were
have proof they were
right,
your
right. I mean, if you do a
purchases.
log, it'll work.
Yes,
but
yeah.
who does that? But the win-loss statement would reflect your true winnings and your true losses, and that's the way it has to be.
Yeah.
And if you are, Ralph, a senior and you're getting Social Security, it's going to make your Social Security 85% taxable. I hate to say it.
Yeah, I mean, because you know what, your winnings for the year may be $200,000 because you know what, that little $300 wins, $20 wins, $70, that's all your winnings, and that's income.
Right.
You know, so you may be have to claim a ton of money on your income tax return, which could kill you out of other credits, which
Right.
could,
Ruin your floor for medical.
Yeah.
It's and that's why
about
when you're a senior and so it's a double whammy. If your Social Security shouldn't have been taxable, then you got this $50,000 in winnings, even though you're going to write off the $50,000 on the back end. You end up with your Social Security being 85% taxable, and so it's as if you've gotten $17,000, for instance, that you never got because you got it and it was going to be tax free, but now it's taxable.
What about, and I could be wrong, but in my thinking, but what about AMT?
That's true. Well, it's true.
If it's
they had-
depending on the income and the loss, how much you're writing
AMT
off.
is alternative minimum tax, right?
So, Ralph, you could be in a lot
And
of trouble.
what I suggest you do is call us at the office, 632-7886, so that we get you squared away so you don't pass out during tax time. And if you don't claim it, I'm going to tell you, because I'm sure you've gotten the statements, the Internal Revenue has a copy of everything. So don't think you can get away with that, buddy.
Well, speaking of getting away with it, Larry writes in, I don't want to say that I have been avoiding the IRS, but I haven't filed for 7 years, and now I'm getting bills for a couple of those years. How can this be? Can you help me going backwards and going forwards?
Yep. Well, okay. So here's the good news and the bad news. The good news is that for those years, the good news is the years that they didn't write you means you had you had refunds coming. That's why they didn't write you. So you probably have some refunds coming. That's the good news. The bad news is when they were writing you for those particular years, it means that based upon their calculations, you owe money. So if you can get the whole thing squared away, right?
Yeah.
You might end up with some extra money in your pocket.
I know this summer or spring, however you want to classify this lovely weather we're having, I had someone come in and he got a bill from the IRS for $150,000 for a
moly.
return he hasn't filed. 90% of that was stock sales.
Yeah.
So
So you got rid of the cost.
got rid of it.
Right. Yeah.
I mean, so just because they're mailing you a bill doesn't mean that's what
You
you're
owe
going to
money,
end up
right.
owing.
But when they send you the bill, though, or they're asking for the tax return, based upon what they have, they think you owe money,
Right.
which you may not. But here's the thing. For the years they're not asking, for those of you that haven't filed and they're not writing you and you think, boy, I got away with it, it means you probably have a refund. And after 3 years, you lose your refund.
So who wins?
Yeah, you just want to make sure that you timely. Just because you haven't heard from them doesn't mean that it was in your benefit. It means that they're going to keep your money if you don't file the return. So you want to make sure you get those returns, even if it's not timely, within
Get
that
'em.
3-year
Yep.
period. If you have a refund, there's no penalties.
Right. And Larry, going forwards too, with going backwards, get those returns filed because so maybe you do owe $35,000 to the IRS because you didn't file for those 7 years. Well, why we can
That's easy for you to say.
Yeah. But we can do an offer depending on your current situation and future income where we could say, look at IRS, yeah, I did have income then, but I don't have it now. I'm now hurt. I can't pay. Can you take $1,000?
Right, and that's an offer and compromise, and we do that all the time.
Yep.
And we have a great staff with all kinds of
we're
experience,
a team. We have
and
a
we
great
really,
team
we
to
really
help
can help
every
you.
person.
Well, that takes care of our email things for another week. Next week we'll be answering your live phone calls, so make sure you call us. Have a great week. If you need us during the week and get some of them love letters, call us at EG Tax at 632-7886. Have a great week. Until then, I'm Esther Gullius with Christopher Fabian. Bye-bye.